Everyone, and welcome to this introductory video of my new YouTube channel called Lake Effect Investments. And in this introductory video, what I'll be doing is just basically talking about myself, who am I, what's my background, kind of what I'm looking to do over here, and what kind of content can be expected from this channel in the future. I'm just getting off the ground with this stuff, so uh, this is basically ground zero at this moment for me. And maybe I mentioned a little bit about this naming convention over here with Lake Effect. So as some of you may know, in the Western New York region over here in the United States, we're sitting right next to Lake Ontario and Lake Erie, which spells a lot of snow accumulation for us in the winter season, and perhaps that's symbolic of what's to come with this channel, or perhaps not. So we'll see. Um, so, anyways, let's move on and let me talk a little bit about myself and my experience, and then kind of what I'm looking to do over here. Okay, so let's start with a little bit about myself. My name is Amir, by the way, and I have about 20 plus years of experience in banking and finance, and mostly that's been in the financial planning and analysis area, so FP&A as it's commonly known. Stuff like reporting, budgeting, forecasting, projections. And when you're doing that kind of stuff, you're looking at a bunch of economic factors as well. So stuff like what the stock market is doing, what the interest rates are projected at, how GDP is trending, employment. So these are kind of like top line factors that a lot of people can identify with and kind of know what they are. But when you're looking to do projections at a more focused level, more zoomed in on certain products, so let's take mortgages, for example, you're looking at a different set of factors, more specific factors like housing starts, existing house sales, and of course, interest rates. I do have experience in retail investments as well. So I've held securities licenses in the past, particularly Series 6, the famous Series 7, and a Series 23, which is a supervisory license. And mostly what I've experienced in terms of retail investment sales is stuff like retirement planning, and then also savings buildup. So it's the stuff like people putting aside a certain portion of their income into mutual funds and trying to do some long-term savings buildup. Um, so this was part of a portion of my career where I served as a financial center manager for several years. And then as part of that, you're also doing banking products. So you get exposure to mortgages, auto loans, personal finances, deposit products, and things like that. Do have experience in balance sheet analysis and management as well. So stuff like interest rate risk management when you're looking to um, work through a structured balance sheet as well as liquidity management. I'm not going to harp too much on this right now, but we may do specific videos in the future looking at certain economic factors where this comes more into focus. Okay, so let's move on to the fun stuff now. Here on the right-hand side of the slide, what to expect from this channel? Um, what kind of content am I looking to put out there? So I'm looking to start a stock portfolio. The stock market generally itself is in a pretty interesting situation. It's widely characterized by uncertainty, sort of an inflection point. The Fed and the monetary policies and the monetary authorities are trying to do a bunch of stuff around it, and a number of scenarios could play out from over here. So within the stock market, or we're looking at a particular profile of stocks over here as well to kind of keep the content interesting, as well as to yield opportunity from these stocks as well. So we're looking at stocks that are startups, right? So that's risky because they don't really have a proven business model at the moment, and they're kind of a little early on the maturity curve. Penny stocks, which are less than $5, are also usually characterized as high risk. Disruptive sectors, right? So stuff like EVs, hydrogen, EVs have actually had a pretty strong success story over the last few years, and they've shot up in a way that's electric vehicles, by the way, shot up in a way that very few people expected. for it to come this far this quickly. Hydrogen fuel has been a bit of a disappointment, kind of the other side of the coin. And then we'll also look at some biomed stocks, biomed and AI, and then kind of AI and robotics. And then real estate investment trust is also an interesting area. Should definitely keep an eye on that. And I need to do some more digging and some more research around that as well. But yeah, that's kind of a flavor of the stuff to come. Let me talk a little bit about exposure. As I myself am investing into these areas. So since this is high risk, um, and people have different risk profiles. They have different risk appetites. So you can, I'm not giving out any investment advice over here or any risk advice. Kind of just letting you know what I myself am thinking and doing. So maybe 20% of your liquid net worth or your total net worth. Liquid net worth is usually qualified as, your cash or stocks, your bonds, stuff that you can convert into liquidity very quickly. And total net worth will kind of include your properties as well. So I kind of usually, I tend to gravitate towards total net worth because property isn't, I mean, it's not illiquid. It's still convertible to cash. It may take a few months to do that, but I think that's okay to include that as part of your total net worth. And then if you're doing this kind of stuff, maybe even 10%, 15% of your total net worth should be your cap. And even that, you should be prepared to basically to part with it if things get really dire. But anyways, hopefully they won't. But the mitigating factors, so let me talk a little bit about why I think that this may be a good point in time to be able to take on such a risk and how that risk may be mitigated. So a lot of these stocks are at sort of a multi-year and even a wide range, a 20-year low, right? So this is a chart by Capital Group, some analytics investment firm that was put out there on the internet, and they're talking about an opportunity in small cap stocks because they are at 20-year lows. So if a stock is at a 20-year low, if a certain sector or a profile is at a multi-year low, that does mitigate it because you're hopefully you're trying to enter into the pricing curve at a point where it's already depressed, given that there's market uncertainty, there's economic uncertainty, and there's uncertainty in the stocks as well. So investors are not very favorable on it at the moment. Certainly not how they used to be. So specifically looking at these stocks, so we're starting at this at in August 2024. So I'm just going to label it as August. And for now, I have these stocks, I'm not basically giving out exact information as to where I'm vested and where I'm not vested and exactly but how much, but more or less it's reflective of kind of what I'm doing right now. So these guys, you got Biomed over here, you got Biomed over here, there's EV and there's some Biomed and AI over here as well, and still building this up. So this is a bit of a start point. And kind of what I was talking about, the mitigating factor, if you pull the 5-year curve on this particular portfolio here, you can see that today it's worth 53,000. So that's kind of with these quantities over here. And this breakout of the portfolio over here. So this group, which is worth 53 today, was worth about $2.6 million on February 19th, 2021. Okay, so let's quickly talk a little bit about that. So you're going to have phases in the stock market where things get very speculative and you get social trends. I'll even call it social contagion, meme stock phases. And you'll get these kind of things that happen, which sometimes, people have called it irrational exuberance. And like I said, it's a trend that takes off. There's meme stock factors and there's a lot of speculation, and you tend to break away from fundamentals. and speculators will try and ride the wave. So, as it's kind of a herd mentality, as the herd comes in and it's rushing one way, you think it's going to keep rushing that way, and you take a speculative position on it in that respect, not really caring too much about fundamentals. So I would just ignore or even just kind of discount this part of the wave, this part of the pricing history, because I don't think something like this is going to happen again, at least not in the next few years. And even if it does, we don't want to break away from fundamentals in that sense. So even if you take away this kind of irrational exuberance piece and you kind of treat this as more of a semi-real peak, or maybe even at this level, mitigate it even further, come down here because it's a little bit closer in our recent history as well, right? Even then, the stock is kind of worth about $750,000. The portfolio is. So given the fact that we're coming in at sort of a low point, multi-year low point, does help us mitigate the overall risk in the portfolio. And I also want to talk a little bit about dilution over here because that's built into these price drops are not entirely real, because what tends to happen with this profile of stocks quite a bit is that dilution occurs. And what is dilution? Dilution is basically companies raising money because a lot of these companies are not profitable, and the way that they continue their operations is that they need constant funding. So they have multiple avenues to do that, and one of those is to issue more stock. And if you're holding certain stock, let's say a company is worth about $100, and you've got $25 of stock within that. So let's say you got 25 stocks worth about a dollar each, and they go out and they raise more capital. So company is still valued at $100, but they're going to go ahead and issue more stock, which means they're going to bring more ownership into it. And whereas previously there may have been four shareholders holding 25 each, now you're going to have like six shareholders. You're going to have two more shareholders come in at 25 each, let's say, for example, and that's going to be a 50% dilution. So your ownership is going to get diluted and the stock price is going to drop. So that's kind of in here. It's inclusive. I'm not going to go ahead and parse that out. It's not really worth it. But I think if you treat this as kind of a more real peak or some kind of a target that potentially could happen within the next few years or so, I think that's okay. That's okay at this point. It's still a substantial gain. Um, Alrighty, so let's go back to this guy over here. So that's going to be, I think, part of a lot of the content that I plan to do for this channel. Economic factors, I think we can definitely do a lot of content around these as well. Some of the nuances around this. GDP, like I kind of mentioned before, unemployment, national debt. National debt and government spending is a very good one to try and understand that and try and peel back the onion on that and try to understand that risk. Um, we're sitting at about a $34 trillion of national debt at the moment. So yeah, about $33 trillion. So we'll come back and talk about that, what exactly that means, and you can drill down on this and break this up, and there's some interesting stuff down there as well. So how real is that risk, right? Um, interest rates, consumer confidence, yada, 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 et cetera, et cetera. So investment sentiment and behavior is also an interesting one. Um, and what I'll just quickly say about that at this point is that if we look at the curve recently, right? Let's just look at let's pull up Max 7. So I have that listed as a portfolio as well. So that's the Magnificent Seven, by the way. So that's Google, Amazon, Apple, Facebook, Microsoft, Nvidia, and Tesla. And combined, they are like, I think, $13 trillion, something like that. And it's come down a little bit recently in valuation. And a huge part of the total cap the total capitalization concentration of the Nasdaq at the moment. So back in 2012, the Max 7 were about 8% of the total market capitalization. And now that's gone up to 23%. So significant concentration over there. So looking at what's happened in the Max 7 just over the last couple of weeks, um, is that we've had this sell-off, which is not so much driven by economic fundamentals as it is by investor sentiment or and investor behavior. So we had a unemployment report come out that upticked um, for unemployment to go up to 4.3%, which I think was previously at like 3.8 or 3.7. And that triggered the sell-off. So 4.3 is still a great unemployment rate. It's still a very low unemployment rate, and it's been very resilient despite interest rates now sitting at whatever 10-year, 20-year peaks for a pretty substantial period of time. What is it? It's been like almost a year now or something. And you've still had significant capitalization in these stocks. I mean, what is this? Could be like 500 billion or $1 trillion. So a sell-off is definitely warranted, and it makes total sense. That people want to take some profit, they want to take some caution, they want to get conservative. They think that it's overextended, that's getting speculative, that AI is going to be able to pull in that kind of valuation. So this kind of correction just makes a lot of sense, but it's hardly driven by economic fundamentals. So we'll talk about that stuff. There's a couple of interesting things that I can definitely do some content on that have happened in the past where sentiment and behavior has largely overshadowed economic fundamentals and caused some pretty strong stuff to happen. So all right, moving on. Yeah, personal finance. I'll definitely do some content on that. I've got some interesting things to share about with my own career and experiences throughout personal finance. So that's going to be with stuff like mortgages, auto loans, personal finance, and it'll keep the overall conversation and the overall content a bit diversified and more interesting, and try and pull in some more extra stuff, related stuff. Who's my target audience? Let's talk a little bit about that. I would say it's people who are a little bit acclimated with the stock market, equities, and economics, but I still want to keep it largely layman. I don't consider myself as a equities insider. I think I'm definitely an outsider, but maybe a little bit more um, acquainted with the subject matter that goes around economics and finance than maybe your average Joe. But still, I want to keep this as much layman and accessible as possible. So definitely looking at a wider target audience over there. So yeah, I think this is probably a good spot to pause for the time being as the opening introductory video. I want to keep these to, I don't know, 15, 20 minutes at the most. And most likely, I think what I'll do for the next one is that start looking at these stocks. Let's do some deep dives into these, into the portfolio, maybe what's going on in the market right now, and do more of a zoom in on this piece over here. And we'll take it from there. Um, and welcome any feedback. And if you have any comments, feel free to drop them down below. Um, and please do do like and subscribe. And we'll see you next time. Take care.